Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with my good friend Doug Hagren. Hey, Doug.
Another good week, another good Friday, Kirk. Ready to talk about all these wonderful little moving levers and triggers that are going on in the economic system the economic matrix that we're all a part of.
Absolutely, yes. It's not quite Good Friday. That was in April, but it is a decent Friday. How about that? It's no, we got some beautiful weather. It rained. It was weird. It rained yesterday. I'm like, this is so weird. It rained. It's been beautiful all summer, so I appreciated the rain a little bit. Walked the dogs. They didn't appreciate it because they wouldn't do their business because it was raining. But whatever.
Can I say this really quick? I've got the same thing with my dogs. How is it the wolves ever go to the restroom? I mean, they descend from creatures that not that far from the tree that lived outdoors.
Our dogs are soft, Doug. As my dad used to say, you're soft. They got it too easy, Yeah, they lay around all day, just hanging out, and then you put them outside, and they don't know what to do with themselves.
Well, maybe dogs are a picture into what has happened, to the humans with affluenza, right? That if you really want to take it in a microcosm and look at how especially we sum it up, first world problems, right? Then you look at your lap dog sitting over there who just gets annoyed that they even have to get up to go to the bathroom. And maybe that right there is just the quintessential example of this is what we're becoming. And it's the human nature, in any animal. If you take all the stressors away, what's the purpose?
Yeah. I don't know. But that's why over the years I've found that one of the best things you can do for yourself is to stress yourself voluntarily. Things like doing an ice bath or going in a sauna or doing like
I'm still not into that stressor.
Yeah, but that's not the point. The point is to push yourself outside your comfort zone.
Yeah.
Right. It could be, for everyone is different, right? It could be intermittent fasting, like you don't eat for like 24 hours or 48 hours or whatever. I was actually just listening to Tim Ferriss in a podcast with Dr. Rhonda Patrick about it. I've always been fascinated with it. I'm not interested in doing fasting. I do other stuff, I like my ice baths once a week. I do the contrast therapy once a week. I feel great. Like it's all about pushing yourself. And I actually gave a talk a few years ago about this to a room full of people in Vegas. And it was basically taking Nassim Taleb book, Anti-Fragile, and really like talking through some of the concepts in how it relates to investing. And if you look at investing, right now, our markets are very fragile. They're easy, nothing going on. They're buoyed by money with the big, beautiful bill. Everything's going up, and it's floating on this sea of liquidity, and everything's fine. There's some bad news. Oh, it goes down 0.5%. Ooh, that's a bad day. No, that's not a bad day. That's not even a speed bump, right? That's just you got a rock in your shoe. That's really nothing, right? Any normal day, it goes up 1%, goes down 1%. That's normal. But in markets like this is what we call a fragile market. Everything's fine. And then all of a sudden, someone throws a rock through your window and everyone freaks out. And then the market drops 30%. And that's a fragile market, right? 2008 was a fragile market, right? 2020, I wouldn't say that was fragile. That was the whole world imploding. But, the late 90s, that was pretty fragile. That's actually really bad. It's the same thing for people. I mean, imagine this. You're sitting on your couch. You never leave your house. You're sitting on your couch all day, watching TV, eating Cheetos. There is no risk in your life because you're not moving. You're not interacting with the world. No one's going to punch you in the face. You're not leaving your house. Nothing could go wrong, right? Except maybe the power going out when you're watching your TV. But nothing's going to go wrong in your house. The risk is close to zero. But you do that long enough, and of course, you're going to start to gain weight because you're not moving around. It's unhealthy. Your body starts to atrophy. And eventually, you end up getting all these bad diseases and you die. Because a lot of that little risk, that small risk adds up. You're fragile, and all of a sudden, it hits you one day and then you get a heart attack or whatever it is, right? But if you're anti-fragile, if you put yourself into challenging situations, if you put your body through stressors, like planned stressors, I'm not talking about doing crazy stuff, but like planned stressors, like an ice bath, which pushes yourself, but not for that long, right? It's not, you're not sitting there all day. You're going in for a few minutes. And putting yourself in those stressors, it causes your body to react and to get tougher, right? So when you experience these rougher situations, your body's prepared for it. It's tougher, right? There's a lot of science that goes into this. I'm not going to get into it, but the same thing applies to markets, right? Health, the better you can put yourself in actually, a good example is going to the gym. You go to the gym, you're lifting weights, you tear your muscles. That's what we call being anti-fragile, because you're tearing your muscles, you're doing your body harm. But what happens when your body repairs itself? Now you're stronger. So anti-fragile is about doing something that makes your body stronger, even though in the short term it's harder on yourself, but it will make your body stronger because it's tougher. Your muscles grow because it's protecting yourself from future tears. So all of that to say, that's being anti-fragile. Now the markets right now are fragile. They're very fragile. And so if I would say for the last like 15 years, pretty much since pretty much 2009, the markets have been very fragile. They go through these easy periods for long periods of time, and then they break, and then they go through these easy periods, and then they break. That's a fragile market. That's not the way markets should operate. And so the best thing you could do as an investor is create a portfolio that's anti-fragile. Now, an anti-fragile portfolio takes advantage of markets when they break. And it doesn't mean you have to wait for the market to go down to make money. It just means you're prepared for it when it does. So if the market dropped 30% today, I'd be fine. Wouldn't have a care in the world because we're prepared for it. If it keeps going up, we're fine. We can make money going up. We can make money when the market's going down. You could do both. And the reality is if you're not thinking about the markets for more than just, I hope it goes up, because as we all know, hope is not a strategy. If you're thinking about it from any other way than I hope it goes up, then your portfolio is basically fragile and you could have problems. So the idea is to create an anti-fragile portfolio. We're not going to get into the weeds now. Maybe we'll do it next week. But the anti-fragile portfolio is really about protecting yourself from big black swan events, things when like the Trump tariff tantrum, when the markets drop like 20% or more in some cases with an event that everyone knew was coming. Or in 2022, when long-term treasuries dropped 50%, quote unquote, safe bonds dropped 50% in 2022 when the Fed said, hey, we're going to start raising rates. But they said that 6 months prior, but people decided January 2nd, we're going to start selling off portfolios because now is important. So, the markets aren't efficient. We all know that. Or if you don't know that, you should just pick your head up and look around because they're definitely not efficient. The academics in corporate finance and economics degrees are just piping up nonsense because the markets are definitely not efficient. So when you see this, it just makes you say, huh, isn't that interesting? So, it's just a pile of evidence that doesn't lead to anything. But if it does, you can at least say, all right, I'm aware of this thing going on over here. It may not impact anything, but if it does, I'm aware of it. Last year, Japan, there was a market tantrum, I think it was in the summer, where Japan started to drop rapidly. I'm well aware that there's a big, somebody called it Japan's a bug in search of a windshield. Like it's just there, it's just ready to blow up, but everyone's ignoring it. So if that happens someday, it's going to get really ugly. So when I start to see Japan melting down, I'm cutting off all the risks because I know where that can go. It didn't, fortunately, but I'm aware that exists. So that's something I'm keeping my eye on. So that's why you need to understand the risks. It doesn't mean you necessarily freak out every day over them, but you should at least know they're there. So if something happens, you're like, all right, I'm out. I'm taking on the sidelines and wait for the dust to clear. So, all right, let's talk about, there was a Fed open market committee meeting. They held their interest rates steady at 4.25 to 4.5. No one was surprised. Trump might have acted surprised, but no one was surprised, including him. This is all pretty much told to everybody. This is going to happen. However, it's been 30 years. It's been around 32 years since a permanent member of the Fed Board of Governors dissented from that decision. Michelle Bowman and Christopher Waller dissented. They thought it was a 25 basis point rate cut. Now, I'm not always that observant, but it's kind of obvious that when Trump says we're going to get rid of Powell, and now you got two people who are basically saying, yeah, we think there's a rate cut coming. We think there should be a rate cut, just like Trump said. I wonder who's vying for the Fed Board of Governor chair for next year. I wonder who that is. Could it be Michelle Bowman and Christopher Waller? I wonder. I mean, to me, it's just all nonsense. It doesn't matter what these people say. It's pretty much whatever the decision is. You could have a slight majority. It doesn't matter. The Fed is a PR piece. It does things for PR. All it's doing is it's just making people feel good. It's all bullshit. All that matters is what happened. Everything else doesn't matter. Doesn't matter why it happened. You could say, well, the Fed said this. They didn't say it. It doesn't matter. Everyone knows if it's going to happen or not before it happens. There's almost never a surprise because they deliberately don't want surprises. So, in my opinion, it's, at this point, it's kind of like, all right, we expect it probably to be cut in the fall. I think right now there's a 62% chance of a 25-point rate cut in September. So I think it's pretty good. We'll see as it gets closer, but that's pretty good. So we'll see what happens. We'll see what happens. The markets are a bit of a mess today, but is inflation getting you down? Do you feel like your money is worth less every time you open your wallet? Is shrinkflation frustrating you at the grocery store? Well, I have an answer for you. We're giving away free money. That's right, I said it, free money. I feel like I'm not doing my part to create inflation. Why does the government get to have all the fun? What could be better at increasing inflation than giving away free money? No, I'm not an employee of the Federal Reserve. And no, I'm not an employee of the US government either. And no, I am definitely not printing it myself. But it's free. What more could you ask? Well, you might ask, is it real? Well, yes, it's totally real. I'm holding it in my hands right here, see? Oh, wait, this is a podcast. You can't see it. Either way, I'm holding it in my hands right now, and I want to give it to you. If you want some free money, go to moneytreepodcast.com/free money to get your free money today. Follow the instructions and I'll send some to you. Enjoy your free money today. I'm not the Federal Reserve, so I only have a limited supply. This offer is good until I run out. Go to www.moneytreepodcast.com/free money to get your free money today. Yeah, what else is going on, Doug?
Well, I mean, we got some new reports out from the jobs report. I mean, the government obviously is saying we've added 73,000 new jobs added in July. U.S. Department of Labor threw out a tweet today. Wages are up. Investments are pouring into our nation. Native-born workers have accounted for all the job gains since January, totaling nearly 500,000 since January. It's always fun when the government has to put out something that sounds like something I would see on a Super Bowl ad at halftime. What's interesting is that there's then some data that's coming out on total private, where they're showing that the private hiring rate fell to 3.6% in June. They're showing that the numbers are close to low levels not seen since 2020. And that obviously they've seen similar to this in other crises at all. And I haven't had a chance to really look at this too closely to see if there's any major chart crimes in it, because this is coming from the Fed, from the Fed. But it tells me there's a little bit of a disconnect there. And and not to get political because I don't think it's any side, but didn't we have conversations leading up the last couple of years questioning or restating of job report numbers, Kirk? And we got a lot of job. What'd you say?
Every quarter.
Every quarter. We got an incredible news. The jobs are they're hiring left and right, hiring left and right, hiring left and right. And now, then we started to get, wait a second, there's the restated that the numbers that we were being told weren't necessarily accurate. And I'm just going to say, and this is my uneducated opinion here. We're getting an advertisement from the Department of Labor saying all these new jobs have come in. Now we have a new administration, we have new people running it. But who do you think cares about these numbers, and who do you think it is that benefits from these numbers sounding really, really good? Whoever's in power.
Everyone is in power. Pretty much
everyone is in power, right? So we're getting new data coming out once again that sounds absolutely glorious. That of course is all 100% responsible for all of the policies that are in place. Maybe it's true, maybe it's not. But there's certainly, the one thing that we'll say is, if it turns out to be true, Kirk, that we did add 76,000 new jobs, that wonderfully came from all of these, as they say it, native-born workers, accounting for all the job gains since January. But yet we're seeing in other reports, such as Fred's Total Private, a hiring rate that actually fell to 3.6% in June. Let's just say the numbers are right, that there was 73,000 new people that were hired. Where would it lead you to believe that new hiring occurred if private hiring dropped? Could it be government hiring? Now, I thought we were going into this year with a discussion of reducing government hiring, but it does not sound like, and there's other data that's come out, that's actually occurred. That once again, that a lot of jobs that have been created are still going back to government positions. So again, there's a lot of manipulation in the data. It behooves whoever's in power. It doesn't matter whoever's in power. They're not going to come out there and say, by the way, congratulations. Since the election in November, we just want to tell you that we've obliterated jobs in the United States. They're not going to come out and say that to you. So the spin there is really, something that needs to be noted. But we are starting to see that, how that, you talk about, fragile markets, and we do have a fragile market. We actually have, we actually have information that margin debt is now up to $1 trillion. That means that, as noted here in one of the posts that I found, that basically, if not everyone's all in, lots of people are in. There's lots of leverage. They're using whatever leverage they can to buy more. It's a 9.5% jump in 1 month. It's ultimately, it's confidence, but it is confidence that's tied to, if we have a fragile market, what are we expecting? We have a public that absolutely doesn't know what to do if the markets don't continue to go to new highs. There's very little discussion that's happening out there about, traditional returns, average returns. Everyone is just celebrating new highs. Now, what happens when we continue to celebrate new highs and other metrics don't necessarily keep up? We get to something that, if we look at something called the Buffett Indicator, right? Which the Buffett Indicator has been one gauge of how potentially outstretched the market actually is. We've actually gotten to a point where we are at 2 standard deviations on the market stretch on the Buffett Indicator, and I'm trying to find it. I have it. Okay, you've got it. There it is. Perfect. So again, if we go back to 1950, which I have to give credit to, this chart. We see a lot of these charts that might only go back to say 1998 or 2015, but this does go back to 1950 with the Buffett Indicator value versus historical trend in 1970 and 2000, and here we are again at 2 standard deviations. And if you notice, I think there's a third one that hit in there and then it dipped back down that they didn't even note. But it was either Morgan Stanley or Merrill Lynch or one of the big ones did a study several years ago that when you start to hit 2 standard deviations out, more often than not, it is an indicator of a imminent pullback. Okay, the markets have never really appreciated being stretched beyond 2 standard deviations. And once we get to 3 standard deviations, then it is imminent. So we've hit a point where instead of looking at that stretching, instead of looking at, okay, maybe where the prices are doesn't necessarily reflect the underlying fundamentals, we again, everybody's just looking for all-time highs. We're going to hit new highs. We need to hit new highs. And if we're starting to see more margin debt achieving that, it tells you a little bit about that affluenza, tells you a little bit about that lack of stress, because we've gotten away from people understanding what the real stress is to where they begin to panic when the movements aren't all that big, but yet they forget about how to be prepared for when they will be.
Yeah, I mean, there's so much to tease out of that. I think one of the challenges that I love the Buffett Indicator, as Doug suggested. I will point out that the markets have changed. I mean, this is a great chart looking at the historical Buffett Indicator, value versus historical trend. It's a great chart. Goes way back, as Doug says, which also is great. You're getting more context. I will say this, pretty much since the 90s, the markets have dramatically changed in their construct. Like the underpinnings of the market are different now. Now, prior to the 90s, things operated in a certain way. And I would say I would argue that they operated in maybe more of a value-oriented manner. There was definitely growth stocks, but the value stocks, you bought things cheap and then they appreciated, and that's the way to do it. Now, people just buy things because they're going up. And the challenge with the markets is value investing has not been in favor in a long time, in part because all people are doing is just pressing the FANG stock button. Buy, FANG stocks. Buy, meme stocks. Like there's no one's thinking about investing. It's like it's basically one big casino, which it always has been, but it feels a little bit less calculated on most people's parts. And so I have 2 problems with this chart. One problem is you see this and it says, oh, we're going to have a recession. Yeah, not necessarily. I would argue that probably that doesn't necessarily lead to a recession. What it shows is that, yes, it's very expensive. And I think we all know that. We've been talking about this for a while. Yes, the market's expensive. It's historically expensive. But here's the other problem. What are you comparing against? Well, you're comparing against the GDP. Now, we talked about this last week in the show. We talked about it a lot. Government numbers are bullshit. They're bullshit.
Well, look at the job numbers.
Yeah, I mean, it doesn't. I stopped looking at government numbers a long time ago. And here's the problem. So look at COVID. I would argue we had about 100% inflation rate after that. Now, it might not have been, but it's in that range, right? Maybe 80, but it's around 100. What did the CPI come in at over those few years? Like 20%, 23, I think it was. I went to the grocery store. It is not 23%. There's nothing except for maybe a laptop computer that is only 20% more. And so I know the CPI is bogus. They keep it low deliberately because they pay a lot of inflation rated payments like Social Security and whatever. And well, that they're going to have to pay more. So why would they have a high inflation rate? They're never going to show a real inflation rate. They changed the numbers back in the 70s and they're not coming back. They're going to be low and muted forever. So it's not going to accurately reflect reality. We all know that, right? I don't have to convince you. Just go to the store. You know, in the last 5 years that things are up quite a bit, not the 20 or 30% that it is reflecting. So you're looking at the GDP number, which is bogus. Okay. You look at numbers like inflation, they're also bogus. And there was, so my first year in this industry, I worked at Paine Webber before they were acquired by UBS. And I remember we had a chief investment strategist. His name was Ed Kirshner. Ed Kirshner was known for being the best guy on Wall Street when it came to trends. He was phenomenal at analyzing trends. And so people used to come and listen to him just because he was so astute when it came to trends. And on top of that, he was a great speaker. He was so entertaining. He really sucked at picking stocks, though. So they started this mutual fund that he did stock picking based on his trend, and they called it the strategy fund. And within like a month, every broker was calling it the tragedy fund because it was just a disaster of stock picking. But I remember the last conference I saw him speak at, and what he said was he showed this like grid, this checkerboard of government statistics. And it was basically like, here are the government statistics, whatever it was, January 1st, April 1st, July 1st, like, GDP numbers or inflation, whatever he was showing. He had a few charts, one of each. So he showed inflation. All right. This month's inflation was 3%, and it goes down each one for like a few years. And then it shows like columns where like basically today, last quarter, quarter before. So you're seeing when it's released on the first column, and then on the first row you're seeing revisions. So they were showing the revisions. So what you noticed was you said, all right, it's 3%. And then next quarter, actually they revised the last quarter down to 2.5. The next quarter after that, they revised that quarter down to like up to 4. Quarter after that, they revised it down to -1, and then +2. And it was like, if you look at all the revisions, it's bullshit. Like they didn't get any closer to the number. In some cases, they got further apart. It was like they decided we're just going to pick this number this month. I mean, who's sitting there in the government offices saying, well, 10 years ago, I need to adjust that number? No, like they're just making, it's like that scene in South Park where they go into the Fed and they go into the back room of the Fed. Everyone's wearing a hood, like the cloak and like the dark people. And they're there and they're like, all right, what are we going to pick this month? They like chop a chicken's head off and he runs around and splats. We're like, that's the number. I'm like, what? Like it was a funny scene. But the point being is the reality of how they're picking the numbers, nobody knows. From what I've heard, a boss just comes to the room and said, here's the number this month. So I don't trust any of the numbers. But if you look back at the revisions, they don't even make any sense. So I don't trust the numbers. I don't really care. All I care about is what is the market telling me? So if the government creates 100,000 new jobs, do I care? Absolutely not. Do I care about a government job? No. Do I care about a local private company job? Yeah, that makes a difference. Luigi the plumber is getting a job is more important to me than Tony the government contractor who's making 7 figures a year just because he knows Billy the politician. I don't care about that. I care that Luigi's got a job. So if you think about and I'm not saying those people are bad in the government contractors because I know a bunch of them. They're good people. But what I'm saying is like if you're looking at adding jobs, you should be looking at the real economy, not the government, which is basically taking over the real economy. Because if you got rid of government as a thought experiment, and quote unquote thought experiment, if you got rid of all the government and all you had was the regular jobs, there'd be a lot of unemployed people and the economy would be a mess, right? Because all these people rely on the government. What if they had to go out and actually work for a living? It'd be harder, right? You'd have to go figure things out, and the government teat isn't there. So, they'd have to find other ways to generate revenue. So the economy would be a mess, and there'd be fewer jobs, people would be unemployed. But why are government jobs growing and not shrinking? Because they're taking it from somewhere. Well, what does that mean? So let's take this thought experiment another level. Let's say there's 1 million people, okay? And then there are 500,000 private sector jobs and 500,000 government jobs, right? Now, let's say next year we have 3% more people. So now you got 1,030,000 people. But we still have 500,000 private sector jobs, but now the government jobs have 530,000. Is the economy growing? I don't know, but it doesn't look like it to me. It looks like the government just says, well, we want to keep unemployment low, so we'll just find work for you. But that's effectively what's happened over time is government jobs have grown and the private sector hasn't. It grows a little, it grows in some areas, but it hasn't grown to the same degree. So if I see a GDP growth of 3%, do I care? I don't. It doesn't mean anything. That's my point. So we can sit here and argue government numbers all day, but the point is when I look at this and it compares it, I think it's a great metric. It's actually one of my favorites. So I don't mean to demean the metric because I actually love it. But the point is when anytime you're comparing it to a government number, just throw it out the window because it's nonsense. They make the numbers up half the time. I will argue that this is one of the most expensive markets we've ever seen, so I don't think that's wrong. But when you're comparing it to GDP, it's kind of nonsense. So anyway, that's my 2 cents.
Actually, I want to add some to that because I agree with you. I don't think that chart it was a chart crime when it said, "Hey, look, indicates a recession." I also reminder, markets valuations are correlated to recessions, but they're not causative. They're not the same thing as a recession. So absolutely, to me, it was more. It was, and I think we're on the same page on this. It was more about. What this is showing is that this lack of understanding of risk in the markets, and everybody is euphoric about all-time highs, I mean, I see posts. I mean, hey, another ATL. We're going to keep hitting ATLs in Bitcoin, ATL in the market. ATHs. Sorry, ATH.
All-time high.
yeah. ATL, Atlantis, the big ATL, all-time highs. The
Freudian
all-time
slip
highs
there,
is
Doug.
all they care about, and they feel as if it's never going to reverse. And it's just like the atmosphere. The higher you get, the thinner the atmosphere is going to be. Now, does that mean that it's going to come back? No. It is possible, if we want to use the atmospheric analogy, that we could have that the Earth could pass through some incredible, galaxy dust cloud. And the Earth's gravity could suck in more atmosphere. We could somehow end up with more oxygen, and all of a sudden, those all-time highs, that atmospheric level that used to be thin, might get thicker. And that's the same thing with the economy. It's possible that there's a new normal, and we have more coming in, more people. I mean, and there's more access than there ever was between the Robin Hoods of the world and the ability for more people to be able to trade, to invest. I think we do have a youth that's probably more educated to invest than they ever were in history, right? And they've started earlier and they're trying to do more and they're putting more into the markets. And we've had a nice 16, year run of effectively pretty good, booming markets. And again, you mentioned something I think, I want to come back to when you say everybody's just kind of, chasing the FANG stocks. They're doing it both intentionally, but they're also doing it passively because of the growth and development of ETFs and the growth and development of index funds. I mean, right now, I just saw that NVIDIA, which wasn't even on our radar when we were talking about the top FANG stocks a year ago or so, NVIDIA is now 8% of the market cap of the S&P 500. Now, that may have changed since I saw this data a week or so ago. But the point is, just by holding index funds, which Warren Buffett instructed everybody in the masses to go ahead and do, as John Bogle and Vanguard, starting with index mutual funds, instructed everybody to do, we do have a new normal in the fact more and more people have started sooner, have stayed more disciplined to investing and just keep putting money in and buy the dip. And we've seen it through the rise and increase of 401k plans, through individual investing, and the rise of passive index fund investing. So we may have, in some degrees, gone through that galaxy cloud and added more into our atmosphere that can allow things to go higher and still have a support that was not seen there 20 years ago. But that does not mean that it can do that into perpetuity. Okay. There is still a thinning that continues. And the one thing that this is showing is the potential that we have stretched to the point so far out that a snapback, and as you can see on the charts, not just a dip, but a sizable and formidable snapback is at a higher percentage of occurring than it was before. And that creates a reason to have caution. The other thing I just want to say is the Kubasi letter just posted earlier today. We've just received massive downward job revision. So get this, Kirk. May's job report was just revised down by 125,000 from 144,000 to only 19,000. And June's job report was just revised down by 133,000 from 147,000 to 14,000. That is a 258,000 jobs that vanished from the data in 2 months. Okay, so I mean, 258,000 jobs that were posted that existed that don't exist.
It's a fat finger trade, Doug.
That's not a blip, people. That is the quintessential definition of we're just making stuff up.
Maybe ICE got them. Maybe ICE took them away, Doug. Maybe that's what happened. ICE took them away, and that's where they all went.
well, we know that is absolutely true because according to the Department of Labor's post, remember, only native-born Americans are taking all of these jobs.
Yeah, it's all bogus. Well, speaking of erroneous data, or in our language, chart crimes.
Yes, let's move on to that. Perfect timing.
Yeah, good segue into chart crimes here. So here's a post Doug sent me. So I thought it was hilarious. It's not a chart, but I'll read it. It took 14 years for the S&P to gain 30% from 1966 to 1980. It's taken over 14 weeks to climb 30% since April of this year. I mean, do I have to
explain? Visualize this chart, and it's like scraping my teeth on a chalkboard.
Yeah. Do I have to explain to anybody why that's a chart crime? I'm going to do it just because I know some people are newer to the show. But I feel like this is so obvious, I don't even need to explain it. It's so bad. So let me try to bring up. Let's see how far back I can get this chart. This doesn't go back far enough. All right. Well, it'll take me a minute to get the S&P 500, but let's look at this. Let's take a look at this. I'll just explain it. So, if you look at 1966 to 1980, the market basically went sideways. Okay. If you look from 2000 to 2013, the market basically went sideways. Okay. I mean, it's just what happened, right? There are times in the market where it goes sideways. There are times where it goes up. 70% of the time, the market goes up. About 30%, it goes down or sideways. When I mean sideways, I mean point to point. January 1st, 2000 to July 1st of 2013, I believe, somewhere around there. It was break even. Then after July 1st, I think it was maybe July 13th, but it started to go up. Okay, so all of the stuff that you see or read is all what we call a narrative. You've probably heard that term before. If you watch the news, you hear it every day, right? They're giving you a narrative. They're not giving you the truth. They're not giving you facts. I know you boomers out there probably think the news is still telling the truth. They're not. They're giving you a narrative, and they're giving you the narrative they want you to believe. Okay, that's just the truth of it. If you don't believe me, whatever party you believe in, watch the other party. You're going to say it's all fake. They're doing the same thing. Both sides are doing it. It's not partisan. So that's how they get you to watch, right? Is by doing that. So 14 years for the S&P 500 to gain 30%. I would argue it took 13 years for the S&P 500 to gain 0%. So what does that mean? You're just picking numbers out of thin air. Secondly, it's taken 14 weeks to climb 30%. You took the low point in the market after the market dropped 20% up until today. You just pick numbers out of a hat. it's the most ridiculous thing I've ever seen. I don't even want to share this tweet anymore. I don't want to give this guy any credibility. It's just total BS. I hate when people do this. It's just it makes for good clickbait. It's brain trash is what it is. Okay, it's brain trash. I also want to share this other chart which Doug sent me, and I can't stop laughing at this chart. All right, so we're not recommending, we're not dunking on any of these stocks, but we're bringing up some stocks just as an example. Okay, Carvana. Okay, this is the company that puts cars in a clear vault that goes up to the sky, and you're going to buy them from there like a vending machine. I don't know. They don't really have them around us, so I only know what I've been told. But anyway, so here's a chart. If you look back here, it's like 2017, starts close to zero. Then it goes up to like 370 in 2022. I would imagine probably December, right before the market crash. And then it goes from there and it goes right down to, I don't know what the low was, $4, $3, 50 cents. It went down to some really, really low number. Now it's back to $400. Okay. You have to look at the video here. Go to YouTube, go to LinkedIn. You'll see the video. I mean, this is the most ridiculous thing ever. So you have a stock that in 2021, people thought was worth, $370 a share. And then a year later, they thought it was worth close to zero. And then 2 years later, they think it's worth $400 a share again. What do I make of that? I'm dumbfounded. Okay, that the fact that this is up 3,500% from where it went public. But if you just look at the chart, it just shows how ridiculous it is. So the question I have, and I don't know Carvana, I don't follow it. I don't know anything about the financials. Actually, when Doug talks, I'm going to probably look him up just for fun. But how does a stock go from 370 down to like 8, back up to 400 within a few years? And anyone can actually look themselves in the mirror and not laugh. Like, what happened? What happened to this company that says, oh, wow, this company's going to the moon. Oh, it's going to zero. Oh, it's going to the moon again. Like, is this a meme stock? Like, what? It might be, but what is going on here? This is the most ridiculous thing I've ever seen. What do you make of this, Doug, while I pull up the financials to poke more fun of it?
What I make of it, Kirk, is, it only took 11. It took 11 years for Carvana to go up.
Touche, Doug. That was good.
3,500%, but it only took 2 years to go up 4,000%.
You're good, man. You're good. I like your sense of humor.
I mean, this is the last statement in a steroid inflated chart right here. I mean, it's like this is exactly what this fool, I'm trying to be nice, in the last comment was basically trying to state is they were comparing a cyclical return, a short-term return, to a long-term secular return. And so, and that's exactly what happened here. Carvana's secular trend is from where it was in 2014 to where it is today. And guess what? Its cyclical trend is where it was 2 years to where it is today. It's just, this is exactly it. Now, you know what I make of it? Well, it is a meme. Well, I make of it.
Hold on.
Yeah. Go. Yeah. Listen, you've got data. Please.
So I brought up the financials. So I just pulled this off a website, and I just want to go through this just to give people reference. And like I said, this is not a pro or con against Carvana, but I just want to share this. So the number of shares from 2018, basically 2018 up to 2017, pretty much when that trend started, up till today are up 225%. That's the outstanding shares. So it's gone up. The number of shares outstanding has gone up 225% on top of the fact the stock is up, which means if those shares weren't doubled, the stock would be up to like $1,200. How many years did it take to
get up to 220? No, never mind.
Yeah, it took. Yeah, so that's there. Total assets jumped right after 2020. Of course, stockholders' equity didn't. You have pretty much negative numbers for the most part. Your debt went up starting in 2021. Debt went through the roof. Started around 2 million or 2 billion. Now it's up to 6 billion. You've got revenues have increased, which is great. Net income really has not. EBITDA really has not. That's all kind of flat. So you have these metrics. Basically, revenues are up, but profits are not. EBITDA is not. You've got assets are up, but number of shares are up. So to me, it looks like a mess. You got a huge amount of debt. What's the benefit here? Are cars a very profitable endeavor? Not really. Or else there'd be car dealerships all over the place that are making money, and they're not. Like, they make money off the service, not off selling cars, but that's a totally different thing.
Well, I will add that used cars, which Carvana is in, makes a lot more money than new cars. Because, yeah.
I will tell you around here, because I don't know the whole part of the country. I know around here, used cars are hard to find. So part of the problem we have, because I just went and bought a car, and I bought a car 3 years old. I think I talked about this a few weeks ago, but I bought my wife bought a new car. My last car in 2011 was a new car. As you know, you can tell, like, I don't buy cars. So it was great. It was a new car right before Fukushima. It's great. Lasted me a long time. I didn't want to get rid of it, but some Yahoo hit me from behind, so it totaled the car because there was $1,000 worth of damage. It totaled the car because it's 2011. So I got a new car. I got a 3 years old car, and I could keep it 3 years, and it probably cost me $9,000 of depreciation. So for me, it was a great deal. But it's hard to find a used car. It was actually not that far off from new cars. So I look at it and I'm like, I get the depreciation, but it seems like these are a lot more expensive than they should be. And they're hard to find. So I think there's kind of a lack of cars in the market right now for used cars. So take that what it is. Anyway, go ahead, Doug.
No, I was looking something. I was looking something up. I was hoping I could get it done before you.
I'll keep going.
I'll keep going. Okay. Yeah. Continue. Give me a second.
Yeah. So I was going to pivot into housing. You want to keep talking about that?
Yeah. Go into housing. Right. That's perfect. Yep.
All right. So all right. So let's talk about housing. We talked about my my decision making process last week of how to buy a house and how to not buy a house. And I didn't talk about how to go after somebody when they try to take advantage of you, but I'll say that for a different episode. I think I shared in the show that the sellers lied to us, and for the one issue that we really cared about, and they lied to us, and frankly, I was bullshit about it. We got made whole, but I'm just sour about the whole thing. Maybe it's just the quality of people you deal with. You just don't want to deal with liars and thieves. But the reality is that housing has changed, and the funny thing is, this person, it probably would have cost to fix the damage, the water damage that had happened. They tried to cover up and tried to sell it to me. It's probably going to cost them between $50,000 and $100,000 to fix. But I'm guessing, because housing has started to slow and these people have dropped the price a lot, I'm betting that it would have been cheaper for them. They would have got more profit off of giving me a discount so we could fix it and moving on, than to let it sit in the market, because now it's going to sit in the market. Prices will be lower. It'll be harder to move. Other people are going to see it. I mean, I think they really lost their window, but whatever. I'm fine moving on. But if you look at things like really Berkshire Hathaway and Zillow say mortgage rates can't fall enough for Americans to afford a home. We talked about this last week about the affordability is for buying a home. It's the biggest spread compared to rent in most recent history. I can tell you, I've been renting for the last 5 years, and I do want to own a home, but it's a personal expense. It's not financial. Financial, I wouldn't buy. I absolutely would not buy right now from a numbers only perspective. I would stay here for the next 20 years and be happy, because it's a heck of a lot cheaper than owning a home. And for those of you who think it's an investment, send me an email and I'll prove to you it's not. Homes are not that you live in. A home that you live in is not an investment. It is a personal expense. Now, if you're renting it out, that is an investment. There's a difference. And people say, well, but you're paying into yourself. Yeah, you got to pay to live somewhere. It doesn't matter. You're paying money out, money in. It's not a good investment. It's better off taking that money and putting it into something that's growing at I think you needed 6 to 8% to outpace the home. Like, it's not that much. You don't even need to do that well. So anyway, but I just want to kind of share that, because that's going on. Also, let's see. There's another chart on the Fred. the most housing per capita in U.S. history. The housing shortage. I know. I see this. I don't even know what to do with this because it doesn't mean anything to me. I think what's going to start to happen though is once you start to see interest rates drop, you're going to see a lot more people dumping their homes in the market. I think people think prices are going to go up. I don't think so. I think housing's dropping. I think that for the moment we're going to start to see in many parts of the country, as we are now, this is actually happening right now. You're going to start to see housing get taken to the cleaners. And I'm trying to find that one chart that was sent here. Here it is. And so estimated market values, estimate history. This is just like an example of one house, by the way. This is not a trend. This is one house. But it just shows like what happened. And this is actually very characteristic of what's happened. So a lot of areas around me, if you go back even further, like 2014 up to 2020, it was pretty much flatlined here. And then 2020, this is actually a bad example. I'll have to find another one. But 2020, it spiked. As everyone knows, housing prices spiked. It spiked, and then it just kept going up. And what I've started to see locally, because I've noticed this, is people are asking these ridiculous prices. Like a house worth $1 million, they're asking like 1.4, and they just put it out there. Let's see what happens. No one bites. 1.3. No one bites. 1 point, and they just keep doing it until eventually it's like an auction. Somebody buys it. I'm starting to see that a lot more now. People are a little bit more wary of it. I'm taking myself out of the market unless I see a steal, which won't happen in this market. But I think at some point it'll kind of come back to a normal-ish level. It won't go to pre-220 because that's when the whole bunch of liquidity flooded the market and everybody's richer now. So it's going to be hard to imagine it goes below that. But I think you could see 2020 levels, whatever that was. I think that's probably realistic. If you see Zillow, don't buy into their estimates. It's all BS. It's all just, their algorithms are wrong, in my opinion. But I think if you look at the context of recent home sales, that's the best way to judge what the local price is. These Zillow things are, as we talked about earlier, they make you fragile because you're not doing the work yourself. Anyway, Doug, final thoughts, and you can wrap it up. I know we're hitting time here.
Yeah. So I think you bring a good point up. I wanted to just say, kind of share, and this is something I run with clients. We're trying to look at kind of the equivalent compound interest return of a house and where to park your money and extra payments, things like that. By the way, right now in my house, I've got 7 faucets that are leaking. We just realized that our sprinkler system outside, I've got one head that's broken and I've got another one that's leaking underground that leads to a spigot that I've got to get replaced. And then the garage door just broke and it's not working. So welcome to the cost of home ownership. So a lot of people have seen a tremendous improvement in the value of their houses over the last, let's just say the last decade. With that, it's easy to look at that and go, my gosh, I've made $300,000, $400,000 on my house. I'm doing an incredible amount of, growth and opportunity there. My house is a great investment. Now, this isn't going to be for everybody, but let's say you bought your house 10 years ago for $650,000. Matter of fact, I'll even make it $550,000. And now it's worth $1,050,000. You're looking at that thinking, this is incredible. I mean, it's doubled in value. I have so much money. Now, over the course of those 10 years, let's say you spent $10,000 just on improvements, repairs, which is light. Generally, it's going to be about 1% of the value of your house. So you're probably looking more than that, over that time. But, the rate of return in that period of time for the house, you'd think it'd be incredible because you see the 550 to 1,050,000. If you subtract out the improvements expenses, and that's not even counting interest that you're paying and such, Kirk, it's only 4.9% in this example. There are people who, have certainly not seen that much appreciation. They might have had a home, that's gone, from, 550 to 850. And, over the last 10 years, depending on where you live, I mean, you're looking at a 2.72% rate of return. It is constantly injecting cash into your home. It is an asset that, unfortunately, if you ever look at those shows on History Channel, what if humans left? What would happen to the town after 10 years? The vines take it over. The animals take it over. it is a deteriorating asset. Is it saying you shouldn't own a home? Absolutely not. But understand that renting or having a home, either way, you're paying for a place to sleep. One of them you have to think of, yes, you do get the ownership and you do get the growth. But on top of that, though, you've got all of the headaches that come with it. And you have to deal with every financial crisis that occurs and comes with that. So it is not cheap. All right. Just understand the numbers. Nobody's saying don't go buy a home. But like when Kirk says, you need to understand that buying a home is expensive, and it is, and there's a lot more to it. This is just an example. I'm going to go ahead and close this out because we're after 1 o'clock. We talked about the data that's come out. There's we've got manipulation in jobs, we've got manipulation in GDP, we've got manipulation in all sorts of things. The numbers you're hearing, who knows what they are? Okay, well, I'm founder of Emergent College Advisors. Before we go, I want to talk about this big, beautiful bill that was just signed into law in 2025. It has dramatically reshaped federal student loan policy. We're still starting to get more and more information out of it. What kind of deductions, what kind of impact there's going to be. Discussion. There's going to be impact on how fast it's calculated. Now is as big of a time to plan as ever. Borrowing caps are very real. Graduate students are going to be limited to $20,500 per year. That's $100,000 total. Professional degrees, $50,000 a year. That's $200,000 total. Lifetime federal loan access now is capped at $257,500 for all levels combined. Plus loans, they're going to be gone. They're going to be dwindling down significantly. That means out-of-pocket costs for many elite programs just went up, and high-income families are going to now shoulder even more of it directly. We certainly hope that there's going to be the cost of tuition is going to come down over time. But guess what? If that does occur like they're hoping, it's not going to happen fast. And that means pain for the next couple of years. By the way, if you're planning on borrowing on a plus loan, if you get it in this year, you are grandfathered. After that, it'll be reduced. Now we've got income-driven repayment programs, including Save, Pay, ICR, eliminated. Borrowers are going to be restricted to only 2 types of plans, standard and repayment assistance. There's a lot of things to know about that. Summarizing, this means far less upside and far more risk, even for borrowers who thought they were covered, even for affluent families who are going to pay more. They're going to qualify for less aid and often handle 6-figure tuition bills. This legislative shift is a strategic minefield. Okay, so we treat this like it is. It's a wealth planning issue. We help families position assets, optimize tax location, model distribution strategies, and create private reserve frameworks so funding elite education does not blow up the rest of your plan. If you've built wealth protecting, or if you've built wealth worth protecting, and you want to fund education without sacrificing retirement or legacy, check out our website, mergentadvisors.com, MERGENT, or mergentcollegeadvisors.com to learn more on the college specifically. The smart money doesn't guess, it plans, and it's now going to require even more sophistication than ever.
Well, Doug, I appreciate you coming on the show. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.